Digest of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hello, everyone. It's James Black here at the Canadian Securities Exchange, and this is your market recap for the week of January 20th, 2023. And as always, I'm joined by someone from StoneCastle Investment Management. This week, it's our good friend, Bruce Campbell. Bruce, I'm welcoming you to the show today to muse on things happening in the market. And to be clear, we're not in Davos, Switzerland, like all of our peers in the industry. We're in our basements. And well, I'm in my basement. You're in your office in Kelowna, British Columbia. How are you? How was your week? And maybe just give me a view from where you are about what you thought the market is doing. And maybe let's do it subjectively, like we do every week. Let's get right into it. I want to talk about Bitcoin. So you sent me a chart, and it surprised me because Bitcoin was going in a different direction than I'm used to seeing it. Maybe we can just start there and talk to people about what the heck is going on.
Yeah, one of the things that we've seen, and we sort of talked about last year, and then I know Jordan talked about last week, was just how we're starting to see more changes in securities that we follow, and there seems to be a bit of a risk appetite, and I mean that's what we're seeing here. We're seeing Bitcoin's made a fairly significant move already this year, and continues to it's been volatile, but it continues to move up here. So it looks like, again, just another risk asset that people are looking to invest back into.
Right. And I believe there was another outfit called Genesis that just went under that was in the space. And, after FTX and all the, fallout from that, it's surprising that didn't completely, mothball this particular asset. But here we are. As you say, it's something that people still see some value in. And obviously those companies weren't in complete control of how it's valued. So more to check, more to observe on that front, I'm sure, as the year goes on and things do change. Here's another topic you brought up: 2-to-1 breadth thrust. Now, I'm not smart enough to tell the people what that's all about, but you sent me this chart of the S&P TSX composite returns. Provide some context here. What is a breadth thrust? Why is it 2-to-1?
Yeah. So what we saw was over a 10-day period, we saw 2-to-1. So 2 times the advancing stocks versus declining stocks. It hasn't happened very often. You can see there in the chart the number of instances it's happened in the last, call it almost 60 years, not that many. And if you look at the returns, the forward returns over pretty much all periods have been very strong. So 1 month, 3 months, 6 months, 12 months, 18 months, 24 months. There's a couple of periods there where you have negative 24-month returns, but they're not very negative. And those were clearly some very challenging times for markets. But if you look at the majority of the times on there, they have very favorable returns. We just saw this. It happened as of the 12th of last week. Or I guess last week,
January, yeah.
And what typically happens is it uses a lot of energy to get this 2-to-1 breadth thrust. It just means that people are buying and they are doing it in kind of real wholesale fashion. Usually gets sort of that point of exhaustion. So if you look at the numbers, kind of 1 month out, they're good, but they're not like sort of mind blowing. But what we tend to see is a bit of a pullback, and then the move moves higher, and this coincides with a lot of the things that we've seen. And it kind of have to shake your head and say, well, how can this be happening? We still have inflation, we still have interest rates heading up. Now everyone's talking about a recession. At the same time, now all of a sudden you've seen this breadth thrust, which again, they sort of come at times when most people are befuddled that it could be happening, and they have really strong returns going forward.
I like that term, befuddled. I feel that way every day when I look at these charts in the market. And, the next befuddling thing perhaps was, I got to get this right. It was James, what's his name? James Bullard, right. Yeah. From the St. Louis Fed. He made comments this week rather, that spooked the market when it comes to interest rates. Now, maybe just outline what exactly he said and what people were expecting to hear.
So The sort of the thought in the market has been after the last CPI report was that coming into the next Fed meeting that they would be increasing interest rates by only 25 basis points. And that's kind of been the consensus. Probably had something to do with the rally that we've seen for the first part of the year. And he was speaking on Wednesday, and you can see the chart here. Market was up for the day on the day. And then he was speaking at a presentation, and he said, no, I think 50 basis points is what's going to be needed at the next meeting. And that immediately spooked the market, and it sold off. We saw, kind of a rather big sell-off on Wednesday, and then yesterday as well. And then today, the market sort of found its footing to a certain degree and has recovered a bit, but it's certainly down from the level where it was when he was talking about 50 basis points versus 25. So it just shows you how fickle the market is and how much the market's really listening to, kind of every whim of what the different Fed presidents say. And they've all really had very mixed messages. None of them are saying that we should be cutting rates, but the amount that they're saying that rates should be increasing and sort of the terminal rate that they think that the Fed gets to are definitely vary between a lot of these different presidents.
Yeah, of course. And to be clear, he's the St. Louis Fed chief, James Bullard. And we've seen the analysis, of Jay Powell, how he, looks down at his shoes could indicate what cuts are coming and at what percentages. But I guess the consensus is that at some point they're going to stop raising rates this year. I mean, can you agree with that, or do you agree with that forecast, or do you think that we might just be looking at further inflationary pressure this year?
Most people that I hear from that are way smarter in economics than I am see inflation continuing to drop throughout the year. That the concern is that does it get down to that 2% target? If you look at some numbers, there were some interesting numbers that a company by the name of Bespoke put out late last year. I think it was in October or November, and they basically showed that if you had a 0.1% increase month over month in inflation, which at that time that was the increase, what that meant for inflation on an annualized basis rolling off. And when you get into kind of the May-June timeframe, it drops below 3% on an annualized basis. If that's where we get to, then I think we would be done increasing interest rates, because that's going to be close enough to their target that they would probably take their foot off the gas. If it stays in that 5 or 6% range, then we could see higher interest rates. Right now, I think most of the market's anticipating 75 basis points of increases this year. So the next two Fed meetings, we would see 25, maybe 50. And then the May meeting, we would see another 25. And then at that point in time, they go on hold. It's going to depend a lot probably on what we see from inflation data, and then also what's happening with the economy. The concern now is that the economy is starting to really slow down, and that these interest rates that they only started hiking a year ago are going to have a lag effect on the economy. And that starts to have an impact now from the rates that they hiked a year ago, and that there's still going to be follow through for probably 18 months after the rate hike.
Yeah. So on the news of the economy and things that are, catching headlines this week, I couldn't help but just throw this title out there, What the Tech. So we actually had you sent a great tweet. I don't know if it was great, but it was certainly fascinating. And this kind of colors the story this week, which was, Google employees, they went to work, I believe this was today, and they put their card up to the card reader to get them into the building. Some were red and some were, green. And if you're red, you go home. Green, you get to go back to work. And this is in light of the fact that Google slashed, I believe, or Alphabet, I should call it, 12,000 jobs. They're slated to cut 12,000 jobs. And that's just days after Amazon began eliminating 18,000 roles. And obviously Microsoft, if you're paying attention, also cut 10,000 or announced 10,000 cuts. So rough math, that's almost 40,000 people. What's going on in the tech sector that's resulting in all these drastic cuts? It's obviously an after effect of what happened during the pandemic, where people were, I think, on two fronts. The tech companies thought everyone were going to move back into virtual environments forever. This was going to push product demand and certain suites of products that these companies were developing. Certainly with Amazon, the delivery infrastructure and supporting all that. And then on the other hand, people would just be mobile, stay at home, and that would, be the way you manage a workforce. This has all changed again. So from your vantage point, what are you seeing in the tech sector? We should be very scared of what's going on here, or is this just an adjustment based on the new realities of a post-COVID world?
Well, I think there's a couple of factors. One is exactly what you said. It's just a reality of the post-COVID world. The second is that, these businesses do see that there is potential for the economy to slow down, and they're, I think, trying to get out in front of that. And so they're starting to cut back some of their expenses, which is in this case in the form of employees. Perhaps they overhired during COVID, and now they realize that they can be more efficient. I suspect that, once they have people back in their office, they are more efficient than they were when they were working remotely. And so as a result, we've seen some fairly significant layoffs here. And that's one of the things that, from an inflation data standpoint, the two real sticky areas that everyone keeps pointing to is owner equivalent rent, which is something that we have started to see some data that's coming down. And the second is wages. And so, if there's a lot of people who are unfortunately losing their jobs, that doesn't really bode well for you trying to get a raise at your job when you go in and negotiate with your boss. If you know that it's possible that when you show up at the building on Friday, your card scan might show a red indicator, which means you don't have a job. So you're probably going to be a little bit more soft on negotiation if that's the case, and that will probably have an impact on inflation. So while this isn't great for the people that lose their job, perhaps it is moving things in the right direction. And this is unfortunately what the Fed is trying to engineer, is that all of us are affected by inflation. And so what they're trying to do is have those inflationary forces controlled, and one of those is through wage inflation. And they know that inevitably some of those people are going to end up losing jobs in order for that wage inflation to come down, but it's going to help all of us in the end. So unfortunately, there's some people in tech and in other areas that will end up losing jobs.
Yeah, Bruce, thanks for tying that back to inflation, because that's where I wanted it ultimately to go, is that, if there's some depression on wages, it actually helps. It actually helps what we're seeing in the inflationary side. So now that being said, it's not all doom and gloom. I had just put up the Microsoft chart, but here's Netflix. Netflix's CEO, I think it was after 20 years, which kind of blew my mind. He's stepped down and left it to a new generation of management. And maybe just talk to me about some of the earnings this week or some of the announcements that have impacted, things for the better. So Netflix would be one. Any thoughts on Netflix or any of the other companies in their basket that perhaps provide some hope that this isn't all just doom and gloom on the tech side?
Yeah, I mean, Netflix is interesting because most of their peers in the streaming area are losing money, and they continue to do quite well. The stock's up today on the news and the announcement. Their CEO is actually still going to be the chairman, but he's just stepping away from the CEO role. There's been kind of a mixed bag this week for earnings. They haven't been disastrous though. We started with some of the banks at the beginning of the week, and then the U.S. banks at the beginning of the week, and then we started to get in some other companies. We saw Alcoa report yesterday, Netflix last night. And, we've got more in the U.S. to report, in the weeks to come here. The Canadian earnings are usually pushed out a couple more weeks away. We start to see the bulk of them, kind of once we roll into February.
Absolutely. Okay. Well, it's not all happening in the U.S. Certainly there's news here on our side of the border. And for that, I'll go back to CSE. So just a few things. There were a few new issues added to the exchange, and I'm actually just going to name off a couple, and then I kind of want to dip into a couple. So companies that showed up at the CSE this week: Showcase Minerals Inc., Golden Age Exploration, both obviously junior mining companies, and I'll talk about that sector in a minute. Moss Genomics Inc. So I need to read off what Moss Genomics Inc. does, because I think it's pretty fascinating, and I'll just give everyone a taste here. So Moss Genomics Inc. is an emerging consumer genomics company that offers personalized health, anti-aging, and wellness offerings guided by genomic, microbiome, and epigenome data. Okay, I can't make sense of that for all our viewers today, but what I want to share is that, this is a company we're certainly going to be providing more information about in an interview, I'm sure, on one of our platforms. And actually, that's something I wanted to share today, was that the CSE does host a regular podcast. And what people can do is they can actually tune in to the CSE's Exchange for Entrepreneurs podcast on Apple or Spotify, or wherever you get quality business content in between your ears. And certainly this is the kind of company we'd want to talk to and share more information about, because just alone reading that, I can't make perfect sense of it. But I know that in health tech and AI, these are some of the trends that I think are going to drive the public market stories and tech side this year. I don't know if you agree with me or not on that, Bruce, but as soon as I use that app last month that turned my face into a beautiful, picture, much better than what you're seeing right here, I think that might have been a tipping point for, consumer AI. Any thoughts on that?
Yeah, I mean, that's going to be a huge area. AI, health, tech, those are all areas that in the future are going to continue to grow and become, more of our daily lives.
Yeah, absolutely. Okay, so look, we're looking forward to another week. There'll be a full week, no MLK Day, which we had on Monday, which obviously truncated our week. So what are you looking forward to for next week, Bruce?
Yeah, earnings are going to be, fairly significant, because there will be another big order of earnings next week. And then the LEI index information gets released early next week as well. So we'll be watching to see kind of, what that looks like. I suspect it's going to be a decline, just how steep it really is. Right.
Okay. Well, until then, we'll be back next week. I'm almost certain Anna Sarin will be back, and certainly StoneCastle Investment Management, whether it's yourself or Jordan Newell, will be back on the program. Thanks again to everyone watching. If you don't mind, hit subscribe, hit like, whether you're on LinkedIn, Facebook, or elsewhere. YouTube, we want to make sure that you guys follow us every week. We always have new insights on the market. So until then, Bruce, thanks for joining us, and we'll see you all soon.